Welcome to MacroHive Conversations with Bilal Hafiz. We aim to bring you the best macro analysis to help you successfully invest in financial markets. For our latest analysis, visit macrohive.com. Welcome to MacroHive Conversations with Bilal Hafiz. We aim to bring you the best macro to help you successfully invest in financial markets. For our latest analysis, visit macrohive.com. Bond yields have been plunging of late, which has gone against the consensus view of reflation. So in this context, we published a piece on why the Fed may struggle to keep inflation above 2% next year in 2022. We also have a piece dissecting the most recent US labor market report and explain why it's showing more weakness than many people think. Then on our deep dives, we have a summary of a new academic paper, which looks into why investors buy Bitcoin. It turns out it's nothing to do with concerns about paper money and the dollar. To find out the details and access all of these pieces, you can become a member of MacroHive at macrohive.com. This also gives you access to our archive of research notes and to our member Slack room, where the MacroHive team and members discuss markets all hours of the day. It's refreshingly different from Twitter. And when you sign up, the first month is free. Then it's only the cost of a few weekly cappuccinos. It's well worth it, and many call MacroHive the hidden gem for investors. So once again, sign up at macrohive.com. And if you're interested in our more high-octane research product for professional and institutional investors, drop me an email at bilal@macrohive.com. Now, onto this episode's guest, Dr. Charles Ellis. Charles is the founder and former managing director of Greenwich Associates, an international consultancy where he advised large institutional investors, foundations, and government organizations in more than 130 financial markets across the globe. He taught investment management courses at the Yale School of Management and at Harvard Business School. He sat on the board of directors of America's largest fund company, the Vanguard Group. And in addition, Charles was a successor trustee of Yale University, where he chaired the university's investment committee with David Swensen. He's also the author of a number of books, including the bestseller Winning the Loser's Game, which has recently come out in its 8th edition. On to our conversation. Welcome, Charley, to the podcast. It's great to have you on. You know, you're somebody who I've admired for a long time in terms of the work you've done with Greenwich Associates and, of course, your excellent book, Winning the Loser's Game. So welcome to the podcast.
Thank you very much. Delighted to be here.
Now, I always like to ask my guests something about their origin story. You know, how did you end up where you are, today and your history? And the way I like to start is to ask you, what did you study at university? And was it kind of inevitable you'll end up in the financial world? I mean, how did you kind of enter into this world?
The logic is invisible. At Yale, I studied art history and philosophy. Then I went to Harvard Business School, largely on the recommendation of the girl I was then dating. She said that would be a good thing for you to do. And once I got there, I realized the most interesting things had to do with finance. And so I got very deeply involved in finance. And investing was not something that was taught at the Harvard Business School in the early 1960s. There was a course on trust administration. It was colorfully called Darkness at Noon. And the reason for that is that the class met from 11 to 12:30. And it was the most tedious and boring course that was taught at the school. And usually not more than a dozen students took it. And they took it because they wanted to get a sure high grade. And they got a sure high grade because the professor was teaching needed to have some students. So he gave out very high grades to encourage students to take his course. A few years later, a very talented professor created an exciting, which became the most important and popular course at the school on investment management. So it was coming, but it had not come. And then when I got to work in New York, which was really mostly entirely good luck, a friend of mine said, "Have you found a job yet?" And I said, "Well, I've got a couple of serious opportunities, but I haven't found anything that I'm really interested in. Taking a look at commercial banking and also broadcasting." And he said, "Gee, that doesn't sound awfully interesting. I've got a friend who's working for the Rockefellers. Would you be interested in talking with him?" And I thought, yeah, this could be very interesting. I thought it was the Rockefeller Foundation, and I thought philanthropy was the mission. And when I met with a very, very engaging man who came up to Cambridge, US, to meet with me at the Harvard Business School, he was such a bright, thoughtful, really interesting man. I realized this is a man I could learn a great, great deal from, and he's looking for someone to work with him directly. This could be a thrilling experience. but I've got to figure out what he does for a living because I'm really not sure. All I know is that it's not the Rockefeller Foundation, it's something else. Well, another half an hour, I realized it was to manage the funds for the Rockefeller family and a series of philanthropies that they had set up over the years. And I really was interested in working with him because I knew I didn't know enough. I knew I would have to learn a great deal. So he said, well, would you like to join us? And I said, yes. And he said, well, that sounds fine. When would you like to come? I said, well, the summer, I was hoping to go out to the West Coast of the United States to see my brother get married and have some other positive experiences, maybe a vacation. He said, that's fine. We don't do much in the summer anyway. Why don't you come in after Labor Day? So I was going to come in on the Tuesday after Labor Day. And just to show you how naive I was at the time, I had no idea what time they would start. So I thought, well, they may start early, so I better get there at 8. There was no one there. 8:30, no one was there. 9, no one was there. 9:30, finally, a group of people started to come in and to get to work. My first venture and effort was as a research analyst to take Wall Street reports, collect them together, and make an aggregate evaluation of an industry. And my direct supervisor, having read that, said, Charley, didn't you learn anything about investing at Harvard Business School? And I said, no, Phil, really, I didn't. And that's when he said, well, you're going to have to learn a lot soon because this family may be rich, but they can't afford somebody like you. So you got to go learn something about this. And he enrolled me in a training program at a Wall Street firm and also said, and you should take some courses. So I decided I would take courses at NYU that had a night school that was a night school business school. And it worked out wonderfully well. Another round of good luck, Bill, if you don't mind. I went to register, and having been in the U.S. Army, I knew how to get into a line and stay there. But I got to the front of the line gradually. This very attractive young woman looked up from a card table with a typewriter on it and said, are you a special student or a regular student? I said, I'm sorry, ma'am, but I don't know what the difference is. I said, well, what was your last school? I said, well, I just finished Harvard Business School. Harvard Business School? That's just amazing. Wow. Well, you should be in our PhD program. And having had 2 very bright siblings that always got superior grades to mine, I thought, well, I may not be as bright as they are, but at least I can take a more advanced course. So I signed up for the PhD program because it didn't cost any more. And then over the next several years, I got more and more deeply interested and realized how much learning was available in the field of economics. And
okay, no, that's excellent. Quite a convoluted route how you ended up in finance there.
Convoluted is the nicest term I've ever heard.
And then, of course, you set up Greenwich Associates, which, I worked in Wall Street in the city for a long, long time. And, Greenwich Associates, the reports we used to get from, you guys was something that everyone in management would kind of scour through the report, see how we were doing relative to our competitors and so on. It's kind of the staple of the banking sort of sector, and it's really quite influential. I mean, what made you set that up? I mean, why, you could have just stayed, working for a family office or for a bank or an asset management company, but instead you went off and set up Greenwich.
Well, I had been working for a stock brokerage firm that was really very good at research, Donaldson, Lufkin and Jenrette, and DLJ had a terrific research capability. And I was representing that in Boston and New York. And I realized I don't know who my competition really is. I don't know why they are, what they're best at, what they're not so good at. And I also don't know anything about how I'm doing. And when I would ask for the clients, is there any feedback you can give me on what I could do better? They say, no, you're doing fine. You're doing fine. And I'd ask again, they'd say, yeah, you're doing fine. Nobody was telling anybody about how you were actually performing. And I thought, nothing could be more valuable than to have accurate information on how well you were doing if you're in a competitive market. And so that was the original thought. And then gradually it proliferated to virtually every financial service in virtually every market around the world. So after 30 years of developing one after another, we had 130 different programs, as we call them, combination of research and then follow-on consulting, that serving the leading firms competing in each of those different markets. And that's how many markets there are in the world for financial services.
I mean, how did you get firms to disclose, their business information to you, because, there's kind of an incentive problem where every bank or every company will want to hear about other companies, but they wouldn't want to share their own information. I mean, how did you kind of get everybody to share information with you?
Well, because we went the other way. Instead of asking our clients for their permission, we talked to their customers and asked them for their evaluations of all the organizations that were competing in the marketplace. So we were acting as principals, financing our own research, because we were able to do a really good job of that. The people that were the ultimate customers encouraged us quite a great deal, because they knew if they spoke directly, they'd get a difficult response. But if indirectly, through us, they could get their services improved, and it would work out well from their point of view. And it did.
Yeah. So it's kind of a win-win then in that case. So they tell you how they rate their banks, I guess, and then you do the survey and the analysis, and it improves the whole industry as a whole.
I don't mean to be immodest, but the reality is it did make quite a great difference, because all these different organizations wanted to do better and better and better. And we kept identifying the young, bright, hardest working, most capable people early stages. So many of the future leaders got an acceleration because we had identified them as doing a terrific job.
Yeah. I mean, at a personal level, I certainly found the report, really, really quite helpful, because, without that, everything's very subjective otherwise. You just have these anecdotes, which then you use as a basis to make a business decision, which doesn't really make sense. You'd rather to have something objective, and then something you can measure year to year as well. Are we improving the quality of our service or not? What gaps do we have in the market? So it was really, really very helpful.
Well, you could have had a nice position with our firm because you really understood what we were doing.
Very kind of you. Now, I really wanted to go on to talk about your book, which is on the 8th edition, which is super impressive. The book's called Winning the Loser's Game. And I, before our conversation, I read the latest edition. And as I was reading it, I realized I'd actually read the book before, about 10, 15 years ago. And so the book is in its 8th edition. So that tells me at least that the message still resonates, for you to continue to sort of publish the book. And it also tells me that the main thesis of the book has kind of stood the test of time as well. And I suppose the essence of the book is, how can you consistently make money in markets, and whether active managers can outperform the market. This is the holy grail, so to speak. And you have a very sort of strong opinions on this. And so maybe you could kind of lay out at the high level your thesis here.
Sure. There are several different ways you could come at it, but the thesis or the conclusion is that the investment managers individually are collectively so very capable that trying to beat them when they dominate the market has become virtually impossible. And that's the thesis. If you do it from the data up, start with the hardcore evidence. First place you'd start would be the record. If you use not a year or a month, but use a decade or longer, and we now have data for 15 consecutive years, how many of the mutual funds that are competing in market after market after market around the world, how many are doing better than an index fund or the market average? And the answer is dreadfully negative. It's not that half can't compete or can't keep up and cover their costs of operation plus their fees. And that leaves out for individual investors the burden of taxes. It's not that half can't do it, but that more than 3/4, more than 85% can't keep up with the market average.
That's really quite remarkable, that statistic. I mean, that's really, really quite high.
Well, it sure is. And it has been hidden for years because we only hear from those who have done particularly well in a time period that they choose. But if you look back at the hard data coming out of S&P Global, for example, that's exactly what you will find. And you'll find it over and over and over again around the world. Now, there are some places where you could argue for an exception. For an example, in China, the market is dominated by retail investors, and they are very much trend followers, and they do not have good research, and they believe they're terribly smart and bright. And okay, there, I think a professional's got a real opportunity to do better because he's competing with non-professionals or amateurs. But if you get away from that one market as an exception, and I've always liked the idea, it's the exception that proves the rule. But if you go to any of the sophisticated or high volume markets, they're now dominated by institutional investors. And institutional investors all have access to unbelievably good information. If you go back and you look at over time, go back to the early 1960s when I first arrived into investment management, then 90% of all trading was done by individuals. They had no access to research. Half of their transactions were, if it was the US market, AT&T, because they wanted a sensible stock to buy. They bought for reasons that had nothing to do with the stock market. They had gotten a big bonus or an inheritance or some other outside the market reason. So that's why they came to the market. They didn't have anything in the way of really systematic research. They did not do comparison shopping, and they did as best they could. Well, were they easy to beat? Yes, they were easy to beat. How much was professional? Well, you could argue how you want to define professional, but roughly 10% was institutional. But when you look at the institutional, most of that was regional bank trust departments. And in those days, US banking was limited to a state's boundaries. So you had 14,000 banks, about a third of whom had a trust department because it was a nice service to offer to their customers. But who was the talent in the trust department? It wasn't very high talent. It was a group of guys who weren't very good at commercial banking. And so they'd been sidetracked into the trust department. And the people that were the most influential were people who were in their 50s on the way towards retirement. Last thing they wanted to do was something that was difficult, complicated, and risky. So that the prospect of what did they do? They did laddered maturities in bonds, and they bought blue chip stocks that you could hold forever and concentrate on the dividends. And were they difficult to compete against? No, they were easy to compete against, as was the case for all the amateurs who didn't have research. But then if you look at all the changes that have taken place since, and these changes are individually major changes, but in aggregate, they're overwhelming changes. First thing you do is you go from less than 10% is professional trading up to over 90% is professional trading, and it's gotten as high as 95% professional trading. Second thing is the volume has increased considerably from roughly 3 million shares a day to 5-6 billion shares a day. That's a major change. And then you think of, well, what kind of equipment do people have? Everybody's got computing power that is extraordinary. 60, 70 years ago, the only computers were used in the back office or cage, and they're used for accounting. Nobody used them in the part of the investment management business. Now everybody carries around in their pocket more computing power than an IBM 360. So we're talking about really remarkable change in technology. And everybody who's a self-respecting investor has got access to a Bloomberg terminal. Many people have a Bloomberg terminal at the office, another Bloomberg terminal at home, and some people have one in the car that they drive from home to work and from work back home again. So everybody has access through Mike Bloomberg's wonderful device to everything you could possibly want to know anywhere in the world at any time you'd like to know it. That's an amazing phenomenon. And then you get regulation FD, fair disclosure, where the SEC at the US says any listed company that gives any information that could be used from an investment management point of view should make a diligent effort. And we need to have it proven to us that it was a diligent effort to get that information out to everyone at the same time. Wow, that's an amazing change. If you look at the securities firms, a major firm like Goldman Sachs would have a dozen analysts. None of them were doing any work for their clients. When you were working at Morgan Stanley, when Barton Biggs first came to Morgan Stanley to start the research operation, they didn't have any. They didn't do any research for their clients. Now, if you look at any major firm, they have 400, 500, 600 analysts working all over the world in offices trying to track down and understand major companies in any industry, and the quality and thoroughness and rigor of their research is simply amazing. And then they're also trying to figure out who's the best at it. They've got research in accounting, research in commodities, research in bonds, stock to bonds, all kinds of portfolio analytics. And there are a number of different ways in which they're all trying to serve. But if you say, gee, if every major firm has got 400 or 500 or 600 analysts doing different kinds of work, there must be an enormous amount of information available. Yes, there is. And it's remarkably good, useful information. No industry has ever been as well served in terms of information providing as the investment management industry. Then the last thing that people usually forget, but it's really worth coming back to, is if Darwin was right, if you're not really good at what you're doing, you will be left behind. And other people who are good will come in and take your place. So there's been a terrific revolution in the talent pool in the investment management field. And part of it shows up in their education, wonderful, wonderful education that people have. Part of it shows up in things like the CFA program, people all over the world studying for the CFA and passing those 3 examinations, one after another after another. It's a demonstration of commitment. I had the wonderful privilege of doing some work in Vietnam, and it happened to cross-fertilize with the first awarding of CFA certificates to Vietnamese students in the business. And there were 29 people getting the CFA at the same time. And it was a major occasion. It was held in Ho Chi Minh City, which we all call Ho Chi Minh. They call Saigon because that's their hometown. But there were at least 350 parents, friends, children there to celebrate at the dinner party while the 29 were getting their CFA certificates. And we globalize things like this. The number of people in India or China that are studying for the CFA is impressive, and it will keep going on. And the same thing's going on in all other dimensions. New and more exciting ways of being able to get darn good information, process it really well, deliver it up to people who are very talented and hardworking in what they're doing. This is a very tough crowd to keep up with, let alone do better than they can do.
Yeah, I mean, listening to you, I mean, I'm just thinking, the stat you reported, 3/4, 85% of managers underperform the market. And at the same time, you give a very plausible explanation why, in terms of everybody is so armed with talent and the latest information that they can't outperform each other. Then it begs the question, why do people try to actively manage their money? I mean, what's their motivation for trying to entering this very difficult game where the stats tell you that you shouldn't do it, the talent pool tells you shouldn't do it, yet so many people do it? Why do you think that is?
Well, Bilal, come on, let's be fair. It's the highest paid line of work in the world. It is, for anybody who's got an ounce of competitive energy, it's the most exciting and dynamic field in which to compete with people all over the world or in any part of the world that you want to. It's a challenge of the first magnitude for someone who's really bright and hardworking. Who do you know that's really bright and hardworking and doesn't want to see, how good am I compared to others? Let me give it a try at it. And if you get paid really, really well, and you get to spend your time working with the most interesting and charming and articulate people that the world has ever put together in any line of work, what's not to like about it? And also, you don't have to retire, as investment bankers have to retire by 50 because they just can't take up the pace and the intensity of it all. If you're in the investment management business, I've known some guys who are still doing it at 100 years of age. And so you get those extra years, and Warren Buffett has proven what a really marvelous difference it makes to go for a long run. Analysis was done of Warren's investment results. And if he had all the same talent, all the same remarkable capacity for origination, and all the same skills, but he had done the more normal thing. He finished high school, then gone to college, then done some graduate study at a business school. And then he did take retirement at 65. If you took that number of years, he would have had, I laugh at this, he would have had only $2 or $3 billion, only. But the snowball effect of going longer and longer and longer is a marvelous beneficiary for those who would like to be able to accumulate a substantial fortune. Plus, you're having more damn fun doing it than anybody's ever dreamed of having. Can you imagine? Is there any other field in which you come anywhere near having so many positive benefits.
Yeah, no, that makes sense. And that, that's why I guess I'm in the industry. That's why so many of the people I speak to are in the industry as well. But you mentioned Warren Buffett, and, in some ways everybody wants to be the next Warren Buffett. And you hear about Buffett's returns, you hear about other hedge funds and asset managers like Renaissance Technologies or Bridgewater or Tudor and More Capital and all of these famous funds that have done really well. That kind of leads me on to the question of, you hear about these great names. And so is there a way you can, become an active manager, succeed, or can you pick these future stars or not? I mean, how hard is that to do?
How hard is it? The easy answer there is it is really, really, really hard. I give you an example of what I think is an easy probability, high probability, easy to explain, and very hard to find. I know an exceptionally talented guy who did all the right things. Went through Harvard Business School, then he worked for Procter & Gamble for several years, then he worked for Salomon Brothers for several years. He's a very, very capable guy, and he has developed an investment management organization that is doing really very, very good work. Have 7 or 8 or 9 analysts, each of whom in their early 40s is truly an expert in the industry in which they're working. Secondly, they have no interest in any company in the 1,000 largest because they're already covered by securities firms and other competitors. So they're working outside the zone where everybody else is competing in industries where they really know from own experience profound insights into the nature of that industry. And they are working as a team together very intensely. They've had superior results. It's no surprise at all that they've had superior results. They do everything the way we would dream about doing it. However, how do they find clients? How do clients find them? It's not all that easy because they've done such good work. They keep clients once they get them. But I spend a lot of time hanging around with investment managers and talking about investment managers with investment managers and with clients. And if you said, look, how many really good investment management teams have you found that over the next 20 years would do a really superb job? The answer has to be almost none, maybe 10, but I'm doing this full time. And it's a maybe 10. It's got to be very, very difficult for those who come without having that much exposure, that much interest, that much time. And those are multiple items that you multiply to create the magnitude of opportunity.
Yeah. And this begs the question of the importance of marketing for lots of asset managers, where there's almost an incentive to accumulate assets, become an asset gatherer rather than a performer, where marketing, the distribution, all of that side.
Bilal, why do you say almost? It is a ferocious, insatiable, compelling proposition to gather more and more assets. And you can explain it away in so many ways. We really had to get more assets under management to create opportunities for the bright young people that we're trying to attract to the organization. Yeah, I've heard that so many different times. Just before the next sentence, we've decided that our organization would do better if we aligned with another global organization. And so we're being taken over by a very large Swiss bank, and we will be crushed under that organization. Okay, find something that is sustainable is really, really hard.
And speaking of sustainable, one of the things I noticed in your book that you emphasize in one of your chapters is how to think about time. So when you think about your investment horizon over, say, 3 months, 6 months, 1 year, 5 years, 10 years, that changes your perspective of how different asset classes will perform for you. Do you want to elaborate a bit more on that?
It comes up to be almost so clear that it's hard to walk away from it. In our activity, in our day-to-day discussions, we tend to talk about a very short term. What's happened in the last day or so really has a dominant fraction of our time. What happened in the market yesterday? What's going to happen tomorrow? That's a dominating factor, maybe a quarter of our time, a third of our time, half of our time. And then what's happened in the last year, what's going to happen in the next year dominates all the rest. And very few of us talk about what happens to be a realistic time frame, which is 60, 70, 80 years. because anybody who's involved in investment management is likely to be still involved in investment management 50, 60, 70, 80 years later. And so we would do ourselves a great deal of good if we would focus on that very long term, which is the reality. We're going to be there and we will be doing that. And if we could think about investment management and our decision making about investment managers in a longer time horizon, and I recognize none of us is able to think ahead 30 or 40 or 50 years. On the other hand, thinking about things as though we were able to think about 30, 40, or 50 years puts us in a right frame of mind. You know, at the risk of being cavalier, most men date women and most women date men who are interesting and fun to be with. But that does not make for what is the right basis upon which to create a great marriage. And yeah, you're sure you want to have a marriage with someone who's fun and interesting to be with. But the more important things are you trust them, they have great integrity of character, they are compatible to you on all sorts of major dimensions. Finance is one, religion is often another, cultural values really take up considerable importance. But it's hard to find someone that you can create jointly a wonderful marriage. And if you can do that by focusing on the long-term variables, the things you really care about, that's your first step towards maturity and wisdom.
No, that's great advice. I mean, I like the parallels between investment management and marriage. I mean, there are lots of parallels there. In fact, just talking about the different time horizons, I've had a guest, a very successful investor, Jim Leitner, on an earlier podcast, and he talked about how he likes to invest for the long term, and the way he deals with the itch of the here and now and the next 24 hours and the noise. He sets aside a small amount of capital which he uses to just speculate on short-term market moves, and that deals with his kind of short-term impulses, whereas the real portfolio he has is very strategic, and that's how he deals with the allure of the short-term side of the markets.
Jim's a lovely guy, and I had the privilege of getting to know him first by serving jointly on the Yale Investment Committee. And then we are now deeply involved in another part of Yale University. And he's extraordinarily bright. He has a marvelous sense of humor, and he has the most incredible range of thinking and the data and interests that he has. He accumulates information that nobody else comes anywhere near accumulating, and uses it in a very talented way, partly because he's extraordinarily bright, partly because he works very, very hard. But he's doing things that none of the rest of us are even trying to do. So he's avoided most of the competition that most of us go to every day. Competing.
Yeah, absolutely. I totally agree. And I speak to Jim very often. He was actually the first client of MacroHive when we set up the company. So it was great to have him kind of endorse the work we do. And you're right that he always is looking at something that nobody else is looking at. And I think that's really makes him stand out. Now, I did want to ask you about valuations, because when I read your book, there's this kind of tension there where on the one hand, you basically want to just have a portfolio where you have exposure to the market or the benchmark or the index or something like that. But at the same time, you kind of hint at various times, or not just hint, but explicitly talk about valuations, how valuations are important as well. But then I was thinking, if valuations are important, then you're saying that perhaps you can time the market in some ways, that valuation-based strategies have some value. So maybe you could talk a bit more about this kind of just having exposure versus looking at factors like valuation.
Factor investing and market timing are worlds apart. Factor investing, for me, is a great deal like deer hunting. You spend a long, long, long time getting ready for a phenomenon that doesn't last for very long. And for most people who are attracted to factor investing, I think the requirement of being patient for very long periods of time is really hard for them to match. And then the second is the ability to recognize when a factor is working. It's almost always nearly over.
Okay, yes.
And individuals will be attracted to factor investing because, oh, wow, look at that record. Isn't that interesting? It's really showing. And they will tend to move into something on a factor-based rationale after it's had its best time than before it has its reciprocal worst time. So for most people, factor investing catches them the wrong way. By the time they see evidence that's sufficiently convincing, it's too late for them to take action, and they will typically come in after the good times are past and experience only the return to normal times, which would be for most investors not very good. Market timing, of course, all of us have learned over the years, we can't do it because we can't anticipate other people better than other people anticipate other people, than everybody anticipates everybody. And this anticipation. It turns out to be a fool's game and not worth undertaking under candidly any circumstances. But there are times when you could say, valuations in the marketplace are really high, or valuations are really low, and you might do something in that kind of a context, knowing that you're going to have to hang on to your judgment for a fairly long period of time. And that will always attract some genuine deep interest and many gifted people. It's a shame that we don't require everybody to write down at least once a year for public disclosure, here's what I believe is going to happen. And just the 3 or 4 things you're most sure is going to happen. Most of us would be dreadfully surprised how hard it is to do that.
Yep. No, I hear you on that one. I mean, so on valuation, over the past 10 years, if not longer, it's performed really poorly, and people have started to doubt how effective it is. At the same time, valuation today seem quite stretched. Do you think something has changed to make value strategies less effective now? So some people have talked, for example, about the role of quantitative easing, that we're just in a new environment where central banks are influencing interest rates and the market so much that it's distorting valuations. Or others argue that the rise of these kind of platform tech companies makes valuations less useful. I mean, do you think there's something that's changed that makes you a bit more hesitant to look at value strategies?
This is not a question I should like to answer. I would rather we could delete this, but I would go ahead and give you an honest try, but on condition that you won't pay very much attention.
Okay, of course. Yep.
I do think we have an interestingly different phenomenon where central banks in major markets around the world are deeply committed to strengthening their economies and doing it entirely with monetary policy, which is a shame because it'd be great if we could have fiscal policy involved at the same time. But we've got wonderfully talented central banks. The U.S. Federal Reserve is simply amazing. But, United Kingdom, Canada, Germany, France, all around the world, we've got some terrifically talented and very well informed. And the information values are extraordinarily higher now than they were even 10 or 20 years ago. And the culture of central banking has been advanced very substantially, and the number of people who are exceedingly talented in every major country that have been attracted to central banking and rewarded in not usually economic terms, but in terms of admiration and respect, has been terrific. But their mission is not to serve the interests of investors. Their mission is to serve the interest of the total population of the people in their country. And so their interest is to see what they can do to increase employment. Sure, bringing interest rates way, way, way down is a way of trying to increase the probability of more employment and more benefit for the ordinary people in those different countries. And that's their mission. And the fact that it happens to have worked out very, very nicely for people who are interested in securities, i.e. wealthy people or super wealthy people, is just coincidental. If they could do it without serving the interest of wealthy people, they would gladly do it.
Yeah. No, that's true. One kind of broad question I have is that, investing in markets, makes a lot of sense, especially when you look at the returns off the market over the last 30, 40 years. But there have been prolonged periods over the last 100 or 200 years where equity markets have performed very poorly. In the 1910s to 1920s, the Great Depression sort of period up until the war. Then we have the case of, say, Japan, with their lost decades. How do you think about those environments, where you have very long periods? It's not just 2-3 years, but it's decades of underperformance of equities.
Well, at my age, you want to be very careful not to be a grumpy old man, but I do think that we are more likely going to experience that than to experience what optimistic people seem to think is going to happen. If you look at economic growth, then think about what fraction of that economic growth should go to capital, what part should go to labor. We've pretty heavy over onto the capital side in the last 20 years. It might rebalance in the other direction. What's going to happen with interest rates? Any chance that they're going to go substantially lower? Not very much of a chance, at best I can estimate. So what if they went higher? Well, back to normal? Yeah. Well, back to normal would be a dreadful impact on the securities markets. Could that make a big difference? Yeah, I think it could make a very substantial difference. So when you talk with people about what do you expect for rates of return over the next 10, 20 years, and they talk about, well, total market, 5, maybe 6%, yeah, maybe a little less than 5, but yeah, 5 to 6%. Like, wait a minute, that's nominal.
Yes.
Take off inflation. The real return is very, very modest. How hard would it be for that real return to be dominated by a reduction in the amplitude of price earnings ratios? Gee, it wouldn't take an awful lot of imagination to bring another 10, 5, 20, some long period of time where the rates of return in the stock markets of the major stock markets around the world were nil.
Yeah, no, that's slightly sort of pessimistic kind of view there, but at the same time, it does make sense. You also, don't seem to be very favorably disposed towards bonds in general. And so, one of the rationales is when you look at long-term returns of bonds, they just underperform, equities over whatever, especially when you look at longer time horizons. But do you think there is some value in having bonds in your portfolio?
Well, it depends. If you ask me, is there any reason for me to have bonds in my portfolio? I think the answer is no. But let me explain why. First, I'm 83 years old, 83 and a half. Anybody in his right mind would say, well, you should be heavily in bonds. And I don't own any bonds, and I have no interest in owning any bonds. Now, wait a minute. How can you possibly justify that stubborn position? Well, a couple of things. Number one, I'm blessed, partly back to our happy thoughts about investment management, but I am able to earn my own way currently, and I candidly quite enjoy doing that. And I love the work that I'm doing. And as long as people are willing to pay handsomely for it, I want to keep doing it. So that's one. The second thing is I'm actually not investing for myself. I'm investing for my wife, who is somewhat younger than I am, and our children and our grandchildren, because that's actually who's going to be spending the money. And it's not that we have a great fortune, but we do have a nice enough savings position so that we're able to get along fine with what we have. And we don't need to have we don't need to have a portfolio that is going to be stable. We can take ups and downs because we're not relying on taking money out of the portfolio to cover current daily living expenses. Okay, it's an unusual situation, yes, but it's delightful, and I hope it'll stay that way. So with a time horizon that's best described as our grandchildren, their average age is 10. They're going to be around for a long, long, long time. Why in the world would they want me to be slowing down what could be their long-term financial power in order to keep my anxieties about stock prices going up and down when I really don't care? Because I don't need to care. Now, I do care emotionally because I like to see things going up. And I do care because I like people being happy. But it really isn't operationally a significant factor in my life. Compared to 20 years from now, 40 years from now, my family is going to be interested in a different way of looking at things. And if you take a 20, 40, 60-year time horizon, and if you're 10 years old, 60 years would say, wait a minute, I'm getting shortchanged. I deserve to have 70 or 75, maybe 80 years beyond my 10th. All of a sudden you realize the time of investing is overwhelmingly the most important part of investing. If you're investing for a very long period of time, you think so differently than if you're thinking for a relatively short period of time. If we were saving now to buy our first home, we would be thinking in terms of 5, 6, 7 years from now, we're going to be making a down payment. That's short term. And would you put that into the stock market? Not me. I'd put it into savings or bonds or something that was stable value, and would try to create enough to be able to do it. But if we know we're going to be spending it in 5 years, that's a very different thing than if you think, no, it's not going to be spent for another 50 years. So thinking carefully about the time allocation is really important to figure out what's the appropriate thing to do in terms of investment portfolio. When you ask most people, what are you doing about your investments? They think immediately in terms of just their securities portfolio. And that leads them to make terrible mistakes in judgment. If you're a US citizen, for an example, and you're bright, I'll think of you and your wife, for an example, both doing advanced studies, both going to have wonderful careers, deep satisfaction, and so on and so on. But you're also going to financially be able to save over a long period of time quite comfortably. It puts you in a very different position. So let me describe the typical student at the Yale School of Management. Men and women, US and international, but they typically are in their late 20s. They are very bright. They are interested in working hard, and they're going to work hard in a field that pays quite nicely, so that their future is quite impressive financially. If you ask the conventional wisdom, well, what fraction of their securities portfolio should they have in bonds? Say, well, they're almost 30, so I guess almost 30% in bonds. And Charley, when you're in your 80s, you should have 80% in bonds. I think that's the worst, most painful, hurtful idea I know of. For the people coming out of a business school, they know that they're going to earn more than they need to spend. They're going to have a very nice economic future. Fine. Why don't they count that as part of their portfolio? Or in the case of my wife and I, we happen to own our own home. It's a stable value. Some people would argue it's a consumer product, which is correct. It is a consumer product, but it does tend to hold its value over time. That's part of the total portfolio. And you can see where I'm going. If you took the assets that you have in the securities portfolio and look only at them, you're leaving out some of the most important parts. Your home, your future ability to save from earned income, the fact if you're a US citizen, you have Social Security coming, and that's a very substantial asset that is part of your total economic portfolio. And if you look at the total portfolio, most of it doesn't go up and down with the stock market. Most of it doesn't go up and down with the bond market. So why do you need to have more stable? Why can't you just accept the reality of your intellectual property at present value is huge? Future Social Security is significant. If you happen to be a likely recipient of inheritance, that's nice. You could add that on. If you're not planning to stop work at 63, 4, 5, but go on longer, which I strongly recommend people do, partly because it's so damn much fun, but also partly because the economics are very, very powerful. Take all those different component parts and put them together to a total portfolio. All of a sudden you realize I don't have to be anxious about the stock prices going up and down because my total financial picture doesn't get changed that much. And the total financial picture is the only one that makes any real sense.
Yeah. I mean, it's very compelling, the philosophy that you have. And it just makes me realize how different it is from the conventional way we think about this. It just tells you I guess, the marketing of asset managers and just the kind of the lack of thought maybe in this. But it's what you're saying isn't the common view people have.
No, but there are a lot of things that are conventional wisdom that don't turn out to be accurate.
Yeah. And you talk about all of this in your book. So, I would definitely urge listeners to read the book. Now, I did want to ask some kind of more personal questions as well. One thing was around, you're obviously very well read and lots of things. I mean, how do you manage, the overload of information and research that one has these days? I mean, there's so much information that gets thrown at us. I mean, how do you kind of manage that all and filter through all of this?
Well, in all fairness, if you take most of the time that most people in the investment world devote themselves to, it's reading reports that I don't receive. So I have much more in the way of free time or discretionary time than most people have. The second thing is that I learned long ago that today's newspaper is usually not nearly as important as the once a year review for trying to understand investing. And that if I could think in terms of even longer wavelength, 10, 20 years, that would really be helpful to me. And the things that I have found most useful are the things that apply and hold validity for 10 or 20 years at a stretch. Warren Buffett's annual reports, I think, are terrific, and particularly if you read several of them over a period of time. And a way of thinking. I think what David Swensen did in the Yale Endowment and the way he thought about things created a different way of thinking entirely. And what a privilege it would be to think the way those long wavelength thinkers are trying to think about things. I also have a simplifying view that the most important part of investment management is character, and that if you have integrity and character working for you, you're very likely to do very well. And if you have character and integrity not working for you, you're in serious trouble, and it's only a matter of when you will discover, oh my God, it's awful, isn't it? But it will happen. I also think that being able to take a look at total picture for an individual or the total picture for the market frees you to say, realistically, so many capable people are now competing in investment management with each other with such fabulous tools and such wonderful information that the chances that they will make a serious mistake and leave it available for someone like me to come in and say, aha, I've just seen a major mistake that I can profit from is clearly zero or negative numbers. These are extraordinarily gifted people who are very good at calculating value and price, and they've figured it out, accept it for what it is, a superb opportunity to take advantage of it. And then if you do that, you very quickly say, I can have all the benefit of all those extraordinarily talented people at far lower cost if I index, because I won't have the transactions costs, I won't have the taxation costs, I won't have the fee costs of anything like that magnitude. And all that work will be done by all those brilliant people day after day after day to serve my interests, to be sure that the prices are as close to right as they can be. Isn't that marvelous? And we're seeing what's happening is gradually people see more and more frequently what the evidence really is and get a sense of what the concepts that conform to that data are. More and more people are recognizing, whether they're institutions or individuals, indexing makes a great deal of sense. And those that are not yet there are going to move in that direction over the next 5, 10, 15 years at increasing speeds because the data is overwhelming.
Yeah. No, that's a very compelling argument. And I wanted to kind of round off by asking you, have there been any sort of books that really influenced you? If you, maybe early on in your career or just in general, books that you think, this book or that book has really influenced the way I think?
Sure. Well, John Burr Williams would be one, because he was the first to roll up the concept that the value of a stock is the present value of the discounted future incomes from that stock. Brilliant insight and very, very well done. I think Phil Fisher's wonderful work on investing in great growth companies shows you how hard it is to find great growth companies. And then if you add on great growth companies that have not been discovered by other people who believe that Phil Fisher was right, if you find a great company, that's a major advantage and very, very rare, but really worth doing. I think personally, Graham and Dodd's wonderful book, Security Analysis, deserves to be recognized as one of the great books of all time because they made it possible to realize that with all the excitement, all the dynamics, and all of the palaver, there is a fundamental reality always in place with regard to investment management and securities. And then, of course, anybody who's right mind would say that Marty Leibowitz's work on bond management, particularly inside the yield curve, one of the great pieces of original thinking ever done. And then my own view, and I think this is very widely held, particularly in the institutional field, the best book ever written about institutional investing is David Swensen's book. about how to think about institutional investing, particularly if you're an endowment.
Yeah. Great recommendations there. And, with that, I think we can wrap up our conversation. And one thing that our listeners often want to find out is how they can follow you. What's the best way for people to follow your thinking or your work?
Well, I do believe in publication. I recognize that's old-fashioned, but at my age, we're all old-fashioned. That's the reason that 8th edition for Winning the Loser's Game is I try to keep that really up to speed with the best thinking that I can find and steal from other people and then make available in an easy-to-read format for people who like to have a go at it. I'm a little shy about this, Bilal, but I am putting together a collection of articles written over the last 50 years and how they show the process of learning and figuring it out, which has been one of the great joys of my life. And I'm being probably the luckiest person you will ever have a contact with. One part of that extraordinary luck, obviously, is being married to the woman I love, which is a terrific experience. But another is to have been in the investment management field when it was the most exciting field in the world and everything was going its way. I don't think this is a perpetuity. I don't think it's going to be that way forever. But I do think that as a major shift is taking place right now, and that's moving away from I will beat the market as the basis for choosing an investment manager to I will help you figure out yourself as a psychiatrist or as an advisor, and I will help you figure out the kind of investing that would work best for you personally, because you are different from every other investor. And each of us is really different from every other investor to some degree, usually significant degree. So you can figure out what's the problem, you're halfway to solution. And if you've got a wise and thoughtful advisor working with you, I think you're going to have a terrific positive experience. But on implementation, I'm quite clear. The jury has returned to the jury box, and they would say active investment management is so unlikely to be successful that you should do something else. And it's marvelous that it is less taxed, less costly, and more reliable, and that's indexing. And then, of course, you have to decide, okay, now I'm going to index which index am I going to do? And what should be my asset mix? And if you concentrate on those things and get that part of the equation really matched to yourself, then I think you've got a wonderful opportunity to be very, very successful. And the best of all is nobody has to lose. We can all be winners if we only figure out what is the right way for us to invest ourselves.
Wow, that's a great set of advice there. So once again, thank you very much, Charley. That was an excellent conversation. I've learned a lot and really important lessons actually for me to hold on to as well and at the personal level as well. So I'd like to thank you for that.
Thanks very much, Bilal.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating and a nice comment and let other people know about the show. We'd be really grateful. Also, sign up to become a member of MacroHive at macrohive.com. We'll be back soon, so tune in then.